Hello, good evening students. Good evening. We are in the cost of capital chapter. So three problems we have done cost of capital. So this is the fourth problem. All I am doing is the previous examination problems. Therefore, they are very important. So we have completed three problems on cost of capital. Now we are doing the third problem. Look at this. PQR Limited has the following capital structure at book value: equity share capital, preference share capital, debentures, term loans, etc. Debentures are redeemable after 3 years and are being currently quoted at rupees 980 per debenture in the market. Preference share also redeemable after 5 years and currently selling at rupees 98.5. The current market price of one equity share is rupees 75. The risk-free interest rate is 6.25%. The market portfolio return is 15.25%. The beta of the company is 1.93. The applicable income tax rate for the company is 35%. We are required to calculate the cost of the following using market value as weighted. So we have to calculate the market value weights: equity shares, preference shares, debentures, term loan. We are required to calculate the cost of the following using market value weights, and also the weighted average cost of capital, and also the weighted average cost of capital. Okay, right. Next, okay, you cost of following using market value as weighted average cost of capital. So we have to calculate. So we have already done one problem similar to that, but that problem I have solved same concept, little bit figures are different. Then why once again I picked a similar problem? The reason is that problem I solved purely on a conceptual basis. Okay, not by using formula. But the examination, for the purpose of time saving, you may not be able to do the problem conceptually. Okay, for understanding the subject, yes, it is, you have to do the problem on conceptual basis. But for doing in the examination, definitely we have to use the formula. So look at the problem number 2. This is our fourth problem on cost of capital. This is our fourth problem on cost of capital. Look at the problem number 2. So I have one more video on problem number 2. Go through the YouTube. We'll identify the problem number 2. So in that problem number 2, similar concept I have solved without using any formula, purely conceptual based. So this problem will solve using formula. This problem will solve using the formula. I have to balance both your conceptual knowledge and also the examination speed and examination scoring. I have to balance both. That is the reason one problem I am doing conceptually, another problem I am doing formula based. Okay, great. Next, so PQR Limited, this is the point. First of all, we have to frame a structure to calculate the market value of it. We have to frame a structure. How many sources are there for us? How many sources are there for us? 4 sources: equity share capital, preference share capital, debentures, term loans. We have only total 4 sources. We have total 4 sources. Therefore, we'll do like this. So we have total 4 sources. So first source is equity shares. First source is equity shares. Next, second source is what? Second source is preference shares. Second source is preference. Second source is preference shares. Second source is preference shares. Third point is debentures. We have 4 sources of finance. We have 4 sources of finance, debentures, and fourth point is term loan. And fourth last point is term loan. Okay, this is the term loan. Right. So for each, first take out the book values. Whatever the book values is there, first take out the book values. Follow standard format so that you will not make mistake in the exam. Always we should be process oriented. Always we should be process oriented. What is the equity shares book value? 1 crore 50 lakhs. 1 crore 50 lakhs. Equity share book value 1 crore 50 lakhs. And preference shares 50 lakhs. Simply 50 lakhs. Preference shares book value is simply 50 lakhs. And debentures book value is same 1 crore 50 lakhs. So debentures book value is same 1 crore 50 lakhs. And term loan is 2 crores. And term loans is 2 crores. And term loan is total 2 crores. 7 zeros. 2 plus 2, 4 plus 3, 7. Okay, total book value. So now quantity we have to take. So how many? So for face value. So what is the face value or par value? So face value. What is the face value of each? So equity shares face value is 10 rupees. Preference shares face value is also, preference shares face value is 100 rupees. And debentures face value is 1000 rupees. And debentures face value is 1000 rupees. Term loan, no, face value will not be there. Therefore, quantity. So what is the quantity? How many units will get? So how many shares are there? Equity shares total value 1 crore 50 lakhs. Therefore, number of shares will be 15 lakhs. Similarly, preference shares and debentures. So I have to remove the decimals for this because those are shares, not amount. Therefore, that should not have decimals. Okay, right? Quantity. So this is what we have computed. This is what we have computed quantity. Next, market price per share. Market price. Market price. So next thing is market price. So what is the market price of equity share? What is the market price of equity share? 75 rupees. Market price of equity share is 75 rupees. And market price of preference shares is 98.50. Market price of preference shares is 98.50. And debentures are quoted at 980. And debentures are quoted at 980. So term loans not applicable. So therefore market value. Market value. So what is the total market value? So 15 lakhs equity shares into 75 rupees. 15 lakhs equity shares into 75 rupees. Similarly, debentures, 50,000 debentures each into 98.5. 50,000 preference shares, sorry, 50,000 preference shares into 98.5. Similarly, debentures, 15,000 debentures into 980. 15,000 debentures into 980. Term loan will take as it is, no per unit. So this is the market value. Now we have to take market value weights. We have to take market value weights. So market value weights, ME based weights, market value based weights. So therefore, what is the total? What is the total amount of all these things? What is the total of all these things? This is the total. So total column will put, this is the total column. What is the total? Okay. Differentiate. So market value weight is this point, 1 crore 11 lakhs 25,000 divided by this market value weight. Okay, 73%, 73 or 74% you can take. So out of total this thing, equity market value is so equity is 74%. Out of 1 crore 52 lakhs, out of 15 crores 21 lakhs, sorry, out of 15 crores 21 lakhs, equity is almost 75%. Very good company. Because equity is more, debt is very less. Very good company. 75% is equity. Out of 15 crores 21 lakhs, 11 crores is equity. Almost 74% is equity. Very good company, safe company. No too much of debt. Okay, right? 74% equity, right? And the total will be 1. And the total will be 1. So these are the market value weights. These are the market value weights. These are the market value weights. Next, cost. So cost of each source, we have to calculate cost of each source. For that, we have to use the working note. For that, we have to use the working note. Okay. Cost of various sources, we have to use the working note. So first, we'll start with the cost of equity. First, we'll start with the cost of equity. Right. Cost of equity. Cost of equity, very simple. They have given the information. They have given the information. We can substitute that information. The current market price of one equity share is rupees 75. The risk-free interest rate is 6.25. The market portfolio return is 15.25. The beta of the company is 1.93. There are different methods of computing the cost of equity. There are different methods of computing the cost of equity. Based on the information given in the question, we'll approach. In the problem, they have given this information. Based on this information, we have to use CAPM, capital asset pricing model. Otherwise, we have some other method also, that is called as dividend based method, Waters method. There are many methods are there, but given the data, we have to use that method. So in the problem, whatever the data is available, with that data, I can use only CAPM, called capital asset pricing model. So the data given in the problem is appropriate to use the CAPM, capital asset pricing model. So as per capital asset pricing model, cost of equity is equal to KE is equal to RF, risk-free rate of return, plus beta into RM minus RF, plus beta into RM minus RF. Cost of equity is equal to RF, risk-free rate of return, plus beta into RM minus RF. So what is the risk-free rate of return? What is the risk-free rate of return? 6.25%. Bank fixed deposit rate. Bank fixed deposit rate 6.25%. Risk-free rate of return. Bank fixed deposit rate 6.25%. What is beta? 1.93. What is market return? The market portfolio return is 15.25. The market portfolio return is 15.25 minus risk-free rate of return 6.25. Therefore, 6.25 plus 1.93 into 15 minus 6, 9. 15 minus 6, 9. So 6.25 plus 1.93 into 9. 1.93 into 9. Let me use the rough calculations. 1.93 into 9. 1.93 into 9. That will be 17.37. That will be 17.37, 17.37 plus 6.25, plus 6.25, 17.37 plus 6.25. How much? 23.62, 23.62. This is cost of equity. No complication ma, all information they have given, just substitution in the formula, all information they have given 23.62, very high. Cost of equity is very risky. So equity shares are very risky. That's why bank fixed deposit rate is 6.25, general market rate is 15.25. Equity shares are more than general market rate. Okay, we have to observe these three rates. Observe these three rates. Where is 6.25? So where is 15.25? Where is 23.62? Depends upon the risk perception. I want to be very safe. I don't want to take more risk. Go and keep the money in the bank fixed deposit. You will get 6.25. I don't want to take any risk. So therefore, I'll go to the bank fixed deposit and I'll get 6.25. No, sir, I'll take risk, but moderate risk, not too much risk. Then invest in the market portfolio. You will get 15.25. No, sir, I want to take more risk, aggressive risk. Then you will get 23.62. Okay, based on that. No risk 6.25, moderate risk 15.25, high risk 23.62. Your choice. Here we are evaluating a company, not a normal individual like you and me. So company always takes risk. That's why 23.62. Okay. So it depends upon. If I don't want to take risk at all, no risk, bank fixed deposit 6.25. Moderate risk, market portfolio 15.25. Very high risk, cost of equity 23.62. Okay, this is first point, cost of equity. Then next. So next concept is cost of equity is completed 23.62. So next preferences. So preferences they have given information. We will use that information. Cost of preference shares. So cost of preference shares KP is equal to cost of KRP, redeemable preferences is equal to, so we have formula. What is that formula? PD, preference dividend plus what? Issue price, redemption price minus issue price divided by n, whole divided by issue price plus redemption price divided by 2. Issue price plus redemption price divided by 2. So what is the this thing? So what are the abbreviations for that? So where, so I have to give a description for that. Where PD is equal to preference dividend amount per share. Next, RP is equal to redemption price. RP is equal to redemption price. Next, IP is equal to issue price. So we'll take IP is equal to issue price. So next, N is equal to number of years to maturity. What is the balance term to maturity? Number of years to maturity. N is equal to number of years to maturity. Okay, N is equal to number of years to maturity. Right. So what is the preference dividend amount? So face value of preference shares is rupees 100. Therefore 10% into 100 it will be 10. Therefore 10% into 100. So face value into rate of dividend. Same place it will continue. RP minus IP divided by IP plus RP divided by, RP minus IP divided by N. Now we got the numerator. Okay, right. Now we got the numerator, denominator IP plus RP divided by 2. So what is the face value of the preference shares? 100 into rate of dividend 10%. Plus what is the redemption price? 100 rupees. Because redeemable, they said redeemable, but they have not given what price. Therefore, we are assuming that preference shares are redeemed at par. And what is the issue price? 98.5. How many years? 5 years. Total divided by 100 plus 98.5. So 98.5 divided by 100 plus 100 divided by 2 plus 100 divided by 2 whole divided by 2. Okay, so numerator we got 100 into 10%, that is 10 rupees, plus 100 minus 98.5, 105. Oh, sorry, 1.5 divided by 5, 1.5 divided by 5. So therefore 98 plus 98.5 plus 100, 98.5 plus 100, 198.5 divided by 2, that is equal to 10 plus 1.5 divided by 5, 0.3. 30 paise, 0.3 divided by 198.5 divided by 2. Okay, 198.5 divided by 2. It will be 99.25. 99.25. Therefore, 10.3 divided by 99.25. 10.3 divided by 99.25. So 10.3 divided by 99.25. It will be 10.38. It will be 10.38. So the cost of preference shares would be 10.38. The cost of preference shares is 10.38. Okay, the only important point is here. So since the redemption price is not given, we are assuming that preference shares are redeemed at par. Since the redemption price is not given, we are assuming that preference shares are redeemed at par. It's always my advice to write that assumption. Whatever the assumption you are using in the formula, you have to write it. Otherwise, it simply indicates on what basis you have done. Whether you have by-headed the formulas, on what basis you have done. So my advice is write an assumption. So what is the assumption here? Since the redemption price of preference shares is not given, we are assuming that preference shares are redeemable at par. We are assuming that preference shares are redeemable at par. Okay, that is what this point 10.38. Next, cost of preference shares, that is cost of preference shares. Next, cost of debentures. Cost of debentures also similar to this. Cost of debentures also similar to the preference shares. Only point is that we will get tax deduction. We will get tax deduction for the debentures interest. On the preference share capital dividend, will not get a tax deduction. On the debentures, will get tax deduction. On the debentures, will get tax deduction. Same formula. The only point is tax deduction for the debentures. Tax deduction for the debentures. So cost of debentures. Cost of debentures. Cost of debentures. Cost of debentures. What debentures? Redeemable debentures. Again, RD. Redeemable debentures. So face value into rate of interest. I should call it as a face value into rate of interest. This will give you debenture amount into 1 minus the tax rate, into 1 minus the tax rate, plus redemption price minus issue price divided by N, whole divided by issue price plus redemption price divided by 2. Issue price plus redemption price divided by 2. What is the face value of the debenture? 1000. What is the rate of interest? 10%. 1000 into 10%. Face value of debentures 1000 into 9%. Sorry, into 9%. So face value of debentures into 1000 into 9%. 1000 into 9%. 1000 into 9% into 1 minus tax rate. Tax rate is 35%. They have given tax rate of 35%. Plus, what is the redemption price? 100. 1000. Not given. We are assuming it as 1000 divided by 3. Because debentures are going to redeem after 3 years. Debentures are going to redeem after 3 years. Look at the numerator. What is the 1000 rupees face value? Look at the numerator. What is the 1000 rupees face value? What is the 9% rate of interest? What is 0.35 tax rate? 1000 is the redemption price. Again, assumption. Since the redemption price of debentures is not given, we are assuming that debentures are going to redeem at face value or par. The debentures are assumed to be redeemed at par value, 1000 rupees. 980 is the present issue price. 980 is the current market price. 980 per debenture is the current market price. Okay, right. So divide by 3. Number of debentures is 3. Number of debentures is 3. Okay, so same 980 divided by 1000. Sorry, plus 1000 divided by 2. So numerator 1000 into 9, 90 rupees. 1000 into 9, 90 rupees. Into 0.65. Into 0.65. That 1000 minus 980, 20. 20 divided by 3. 20 divided by 3. Whole divided by, so 1980 divided by 2. 1980 divided by 2. So 90 into 0.65%. 90 into 0.65 will get 58.5. So 58.5 plus 20 divided by 3 plus 20 divided by 3 is equal to 6.67. 6.67 divided by 980. 1980 divided by 2, 990. 1980 divided by 2, 980. So 585. So 58.5, 6.67. It will be 65.17. Numerator is 65.17. Denominator 990. Denominator 990. So 65.17 divided by denominator 990. It will be 6.58%. It will be 6.58%. 6.58%. So 6.58% is the cost of debentures. The only difference between debentures and preference shares is the tax deductibility. Dividend on preference shares is not tax deductible. Interest on preference shares is tax. Sorry. Dividend on preference shares is not tax deductible. Interest on debentures is tax deductible. Assumption, redemption price is not given. Assumption. Okay, right. 986.58. Next, cost of term loan straight away 9.5% into 1 minus tax rate, because nothing like redemption price, issue price. So term loan directly you can take 9.5 into 9.5%. So therefore cost of term loan, no issue price, nothing. Cost of term loan, no issue price, nothing. Cost of term loan, no issue price, nothing. So post-tax cost is equal to pre-tax cost into 1 minus tax rate. Pre-tax cost is how much? Pre-tax cost is 9.5%. Pre-tax cost is 9.5% into 1 minus 0.3. 1 minus 0.35 into 1 minus 0.35. Okay, 1 minus 0.35. Therefore, 9.5% into 0.65. 9.5% into 0.65. Okay, 9.5% into 0.65. How much? 6.175. 6.17. I can take 6.17%. This is where you have to be very conscious. Look at this. An illiterate person, a normal person, a non-commerce student will feel that debentures has lower cost, because debentures coupon is only 9%, whereas term loan coupon is 9.5%. Therefore, a normal person, a non-commerce student will assume that issuing debentures is less costly, term loan is more costly. But as a financial analyst, if you observe that debenture cost is 6.58, whereas term loan cost is 6.17. Therefore, always it is advisable to go to the bank. So when the banker gets delayed, when we want the funds immediately, then only it is advisable to go to the market for issue of debentures. Because getting a bank loan is not so easy. There are many procedures and many securities has to be given. In case of debentures can be unsecured, but normally banker will give secured loans. But to the corporates, banker will give secured loans. Therefore, the advantage of bank loan is that less cost, but the disadvantage is time taking. The advantage of debentures is that more easily you can get it, but the disadvantage is more costly. That is where the difference between commerce student and non-commerce student will identify. So a non-commerce person, a layman, will think that debentures are less costly. Layman will think that by looking at this 9%, layman will think that debentures are less costly, therefore I'll go for the debentures. No boss, debentures are more costly, 6.58%. Because of that, because of the flotation cost. Why 980? Why 980? Because the flotation cost of 20 is there. Because of the issue expenses, debentures, though apparently appears to be 9%, it is more costly. Debentures are more costly. So though apparently it is less, the debentures are more costly. This is where the difference between a financial student and non-financial student will come. So when you analyze in deep, debentures are more costly than bank loan. When you analyze only, when you look at prima facie, when apparently if you look at the balance sheet, term loan appears to be more costly and debentures appears to be more cheaper. But if you go in depth into the problem, we'll identify that debentures are more costly. Why? Because issue expenses. Because of the issue expenses, because of this underwriters commission and merchant bankers commission, they will charge huge amount. Because of the issue expenses, cost of debentures are more. Remember, for taking a bank loan also we have some expenses. That is called as processing charges. Go and ask any person, bank loan. So normally if you go and take a bank loan, they will charge something called as processing charges. Go to normal mobile shop and take a mobile on loan using Bajaj Finance. They will charge processing charges. Therefore, for term loan also there will be some processing charges. But normally the issue expenses are far higher than the processing cost of the bank. The issue expenses are far higher than the processing charges of the bank. So therefore, always bank loan is cheaper when compared to the market-based debentures. But why the people will prefer is that normally security, you may or may not give security, that is first point, and you can quickly get it. When compared to the bank loan, debentures you can quickly get. That is the important point. Okay. Right. So cost of debentures 6.17. So we got everything. We got everything. Just substitute in our table. Just substitute in our table. So what is the cost of equity we got? What is the cost of equity we got? Cost of equity we got is 23.62%. So cost of equity we got is 23.62%. 23.62%. Cost of equity we got 23.62%. Preference shares 10.38%. 10.38%. Debentures how much we got? 6.58%. 6.58%. And term loan how much you got? 6.17%. 6.17%. Wait. So therefore market value based cost. Market value into cost. Market value into cost. This is called as weighted average cost. So this is called as weighted average cost. Market value based cost, weighted average cost 17.47. 17.47 is the equity based weighted average cost. Therefore weighted average cost will be this 19%. We'll see whether decimals are there. Yes, 19.25%. This is our final answer. Therefore I'll put in the green color so that you will understand this is our final answer. Cost of equity using market value weights. So this is the market value weights. Use the same standard format. Use the same standard format only for the cost of, for calculating the cost of individual components. Use working notes. For calculating the cost of individual components, use working notes. Remaining will come from the table. The same table if you follow, you will get the remaining points. Okay, market value based cost. So be clear. So wherever the assumptions, preference shares and debentures, redemption price is not given. Therefore, assuming that they are redeemable at par, debentures, interest is tax deductible, preference dividend not tax deductible, and apparently though term loan appears to be costly, but if you go in detail, debentures are more costly than the term loan. Okay, that's it. That's it for this problem. Thank you.